Hi, everyone. Welcome to the Research at Citi podcast. I'm Ann Malone, the North America head of equity research at Citi. With me on the podcast today, and I'm pleased to introduce Steve Zaccone, the analyst here who covers Broadlines and Hardlines at Citi. Today, we're going to cover a whole bunch of things, but all of it surrounding the consumer, spending trends now, and of course, what the future holds. Steve, it's great to have you here.
Thanks, Ann, for having me on. Happy to be here.
Okay. The other day, a client approached me and was pretty excited and curious and asked if analysts get frustrated when we're in a market that's so overshadowed by macro factors, implying that fundamentals don't seem to hold as much sway. In my mind, the consumer space is a new twist on that. One would think the macro would have more impact on consumers, but the resilience is so notable. And I think you and the team tried to cover that in your recent macro to micro note. What's your take on the consumer?
Yeah, I think it's a great question, and we tried to dig in this note, and we brought together 12 analysts, the economics team, so we really got a kind of a broad view. And resilient is kind of the word that we've heard, and I think it really makes sense because it's been an uncertain time in terms of the consumer backdrop, right? There's been challenges that we've had to deal with, whether it's been tariffs that have popped up this year, geopolitical uncertainty, right? On the flip side, there have been some tailwinds, right? Like the wealth effect is very real for the middle to upper income consumer. You know, uh, Equity markets are at all-time high, housing prices are high, right? The unemployment picture has been it's held in. It seems to be weakening a bit, which we can kind of go into, but still, generally speaking, things have been pretty good from an economic backdrop. So I'd say resilient is a good kind of theme. There's certain categories that have been better than others, but resilient has been the theme we've heard, and it seems to continue to be the view going forward.
And that's the city view that this resilience and the tailwinds and headwinds are still going to continue.
Yes, yes, the city view, no recession on the horizon, right? We've seen somewhat of a weakening labor market, which could be something to watch in the back half of the year. We are seeing tariff costs kind of trickle into products. That's going to be something that's a focus for the consumer as we get into the fall here, and then really most notably into the holiday season. Are you going to have to pick what you're going to purchase because prices are up? But yeah, I think the offset is, rate cuts are happening, which should be a tailwind, right? You still have that wealth effect. That's like balance sheets are in good places, right? And that higher income consumer is probably driving most of the spending overall. And you've had some fiscal policy, right, with the tax cuts that are becoming permanent, which should be a tailwind as we get into 2026. It seems to favor more the middle to upper income consumer, but these are all tailwinds that kind of, continue.
So many different ways I could take this conversation, but I'm just going to pick one. Let's start with tariffs. Some of the numbers in that report, the wallet winners and losers, are pretty stark. I'm going to quote you: the effective tariff rate on U.S. imports is just a notch or two below 20%, up from around 2.5%. So, what does that do to prices, inflation, and maybe most importantly, my credit card balance?
Yeah. Um, Prices are up, right? And I think there are certain categories where it's worse than others, right? So if you think about furniture, we don't really do that in the United States in terms of production. And even some production that's done here is imported, goods are imported from outside the country. So that's an area where, pricing could be up mid to high single digits, maybe even double digits, right? And it probably staggers in terms of price increases. There's other places where if you're largely domestically sourced or you don't have as much pricing increase, like maybe you're only up low single digits. But in terms of goods, that is where you're seeing a lot of inflation, right? On the services side, right, take like a restaurant's world, for instance, you're not going to see a lot of tariff inflation there. The theme there has been really like labor costs have been up and food inflation, and that's been an ongoing theme, right? It's not necessarily a new shock this year. If anything, it's probably easing a bit, like services inflation. So when you think about the areas that are really most impacted by tariffs and that 20% number you cited, it's more of like the hardline retail kind of categories that are imported goods.
So is the thought we haven't seen inflation or we haven't seen inflation yet?
We've seen inflation, right? I mean, if we rewind, right, 2021, 2022, we saw a lot of inflation, right? And I think what was different then is the consumer was kind of flush with cash, right? And you were able to pass that price on. There was relatively inelastic demand. If we go back to economics 101, I think the focus here in the back half of the year, as you start to see tariff costs kind of trickle in, is like, what is the elasticity of demand? There's certain categories, right? Like take an auto parts retail, for instance, which is needs based. Your brakes are broken, your battery dies, like you have to fix it. You can only defer that for so long. That's a relatively inelastic product that's imported. Furniture, electronics, a little bit more discretionary in nature. Maybe you'll be more choiceful if certain product pricing is up a lot, like maybe you'll kind of defer something and make a alternative purchase. I think that's where there's a very big focus on elasticity of demand as we get into the back half of the year.
So this is probably a good time to start talking about the wealth effect. And from that, I can't help but connect it a little to the subcategories, right? Because not everyone needs to go on a cruise, but everyone needs to eat. So let's talk a little about that. It seems saying the consumer is resilient very much has to do with where you are and the wealth effect. So let's talk a little about that.
Yeah, the middle to upper income has really been leading. And part of that is driven by the fact that you've had this wealth effect with asset prices at all times highs, led by the equity markets, right? Housing prices are still high. You have good balance sheets. And in terms of the employment picture, like white collar employment is still really strong. Where we've seen some more challenges has been on the lower income side. They're perennially challenged, but I think they've also been dealing with very high inflation for food for the last couple of years and other areas of inflation. If you look forward, it still feels like the middle to upper income is going to be the ones that kind of outperform, right? They're probably able to deal with a little bit of tariff cost inflation. Equity markets, if they continue to kind of grind higher, that's a net positive for that group. And if the labor market weakens just for the lower income consumer, it probably doesn't trip up that middle to upper income. So where does that benefit? I mean, you tend to think of like categories that are exposed to kind of the homeowner that probably sees a recovery. There's a debate a little bit more on rate cuts there in general. Luxury is an area that's kind of lagged, but maybe that has a bit of a recovery. If you think of just the secular shift in spend, travel has done well for the US consumer. That probably continues, right? You think of some of the leisure and like hotel kind of ways to play that. I think conversely, on the lower income side, when you look at staples, like that's been an area where you have seen some weakness. Even in restaurants, you have seen some weakness. And that's where that lower income consumer is kind of prioritizing how they spend their dollars. Do they have to trade down to private label, right? Like when they go to the grocery store? Do they have to prioritize how far their dollar goes when they're going to a quick service restaurant? Like, is there one choice that you get a better option or value than others, right? So I think the low income is one where you've really had a focus if the consumer has to make choices. Middle to upper, I don't think you've had that as much. We'll see if that changes over the next 6 to 12 months as feel a little bit more tariff cost inflation. But, that low income is where you've had to make more choices.
It's now 3/4 of the way through 2025. Is there any conversation that needs to be had on COVID or post-COVID or recovery from there or things that have changed permanently, or are we past that conversation?
Yeah, it's a good question. It feels like we're past the hangover period, right? In the report and some of the good government data that's out there, there's a good focus on personal consumer expenditures and durable goods have kind of stabilized. Like they were areas of weakness the last couple years as there was that pent-up demand to travel and go out to eat, right? And 2024 and then 2025, we've really seen a stabilization in terms of those goods categories. People are buying the TV, buying the appliance, right? Like there's replacement cycles in furniture. We'd love to see rate cuts happen for some of these big ticket goods, and we'd love to see the housing market improve because that really gets some of these categories going. But generally, we've seen a stabilization. I would say from a services perspective, we outperformed in the period past the pandemic. You've probably seen some normalization. People probably push back on going out to eat at restaurants when the pricing gets a little bit too high. So it feels like we're in a bit of a normalization after some really strong years of growth in those sectors.
Isn't it amazing? 5 years ago, the common wisdom was no one would ever cruise again. And look at that area of strength. It's talk about resilience. Unemployment. You said you wanted to touch upon that a bit. And is that again back to our lower income versus middle income that the spike in it is in that same consumer who seems stressed?
I think so. That's a big focus right now because when you look at some of the consumer sentiment data out there, it's not great, right? It's deteriorated. And I think some of that though is it's a bit more weighed towards that lower income consumer that you've been feeling years of kind of grocery inflation that's very high. Right now, maybe the unemployment picture is like weakening a bit. I think that's kind of the focus going forward. I said earlier, like the low income consumer feels like it's kind of perennially challenged. And I think that holds true. The tax cuts that are going to become permanent, there's a good analysis kind of looking at some of the refund checks that could go out next year that they're somewhat retroactive. So there could be some benefits to the consumer that hit in the first quarter of 26. But the sweet spot is like 90,000 household income and above. So it still feels like that middle to upper income consumer is going to be in a better position. Now, the Fed has noticed it, right? And I think they've recognized that the labor market is kind of weakening. So it's nice to see you've got that caveat that you could see some rate cuts, which should be stimulative anyway. But I think that could probably benefit that middle to upper income consumer anyway, right? It could be positive for asset prices, which that's really on the balance sheet of a middle to upper income consumer more broadly.
E-commerce. We don't talk about that as much as we used to. Do we all know it exists and the shift is largely over? What were the numbers like there about? I have to admit, I'm still someone who heads into a store, but I do use my Amazon account. So where does the e-commerce play into any of this?
It's a great question. The biggest shock in terms of e-com is probably over, right? Like in terms of like the increase as a percentage of retail sales, you're kind of running in the 21, 22% of overall retail sales today. Our forecasts in this report we did with our internet team gets to like 27% by 2029.
Is that a US number or a
It's a
global
US
number?
number. That's a US number.
And
Yep.
I assume the rest of the globe is running behind.
Probably
Yes.
be lower. Yeah, I would
Yeah.
think
Okay.
so.
Yep.
I mean, Amazon is kind of leading it, right? Like we cover some of the big retailers as well, the Walmarts, the Costcos of the world. The shock has really happened. Now it's just like a continual grind higher. I think what's fascinating with e-com is like how does it change with the growth of AI? Because I think there's implications for consumers how they search for product, right? And that has ramifications of like how do I get to this retailer that I used to previously just go to a search engine and look it up and like I would get to retailer ABC. Now it's like how do I survive in like the world of the chat GPTs of the world, right? There's elements of like how shopping changes where you may have AI, shopping for you and you don't really go to the store. It's really powerful too for some of these retailers where years ago you go to a home improvement store because the person who worked there knew how to do the paint or the plumbing or whatever. Now, if you've got an associate that has some AI capabilities and tools at their disposal, like they can really help you make that purchase. So I think that's really the next step function when you comes to the consumer and how they make purchase decisions is how does AI kind of inform those decisions and who are the companies that are really prioritizing the investment to gain that share.
We went almost 15 minutes without bringing up AI. That was kind of an impressive record. Outside of retailing, though, do you see a big impact? Right. I think AI, that first thought is always that how does it customer service? So I guess leisure, hotels, restaurants, they can all find some productivity gains as well.
Yeah, it's probably productivity gains there, right? I would think, that's probably the opportunity. I think What we've heard from retailers is it's really the search function is the first thing because so many companies were built on I go to Google, I search in comfy couch, and it's going to send me to who's going to cut like the top locations, right? Now it's just if you're not starting your search journey there, where do you go? From a productivity standpoint, I think that's where it can probably help into leisure and stuff. And in the restaurant world, I think we've seen like automated kitchens, right? Like that's a big theme that John Tower can probably elaborate on in his space. But there's definitely changes that are happening, and it's a continued area of investment for these consumer companies, both CapEx and OpEx.
Right. Across every space, right? So no reason that consumers shouldn't be any different. Before we get to closing this out, I can't believe it's September. So what are you thinking about for holiday? What's the thoughts there?
The forecasts from industry wide, even ours, are fairly encouraging. Last year was a good holiday season. If you remember last year, we had the election caused a lot of distraction for the consumer, call it September, October. And then what we saw was just a relief, regardless of what political party you were, was just like, oh, it's over, right? The headlines are, I don't have this distraction anymore. So people really went out and spent during the holiday season last year. So it is somewhat of a tough compare, but I think the view right now is cautious optimism. I brought it up before, and I think it's important to highlight though, is that you're going to see some tariff costs kind of trickle into the assortments, right? And I think the messaging from a lot of consumer companies is they kind of started post Labor Day, right? So that's when you started to see bigger price increases. And we'll have to see how that plays out. I think there's certain categories that are going to be more inelastic. I would think because of the tariff costs, you're going to see a lot more promotional messaging, right? Like who's going to be able to kind of drive traffic. Like cautious optimism is how most people kind of think about holiday. The last thing I'd say is like, these tariff things, it's very unknown because you could see a scenario where if things come in a little bit weaker than expected, there's certain categories where things can get very promotional, and like Paul Legway covers some of the apparel names and he's a little bit more cautious just because it's difficult to kind of pass on price in categories where you don't historically have pricing power, right? Like some of the categories where you're more inelastic, like grocery, auto parts retail, right? Even home improvement, you can kind of pass on that price. And others where it's much more competitive of an industry, it's challenging.
Talk about cautious optimism. Let's finish it with you've laid out this view. What could derail the consumer? What's the one thing that is the most worrisome that could derail the whole thing?
Yeah, I mean, what worries me is like we've grinded higher in terms of the equity markets for the last 3 years, right? You had 2 years in a row of 20% returns for the S&P 500. This year continues to be really strong. If you see a pullback in the equity market of greater than 10% or 20% again, like I think that's always a concern for that middle to upper income consumer, right? That's like, holding up spending. And then I would say the employment picture. It's weakening a bit. It seems like the Fed has a handle on it and will cut rates. If it really deteriorates, that would be an incremental concern. I think the equity markets have been long and strong. And like if that changes, then you have that middle to higher income consumer that has to rethink how they spend.
Makes sense. Thank you, Steve. Always an interesting conversation. This podcast was recorded on September 24th, 2025. Be sure to join us for our next Research at Citi podcast, which will feature our U.S. economist Veronica Clark with Rob Rowe, and they'll be doing a Fed update. Thank you.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyrights 2025 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.